It was a quiet Thursday in June 2020. The world was already tense, grappling with a global pandemic. Then, a single, unbelievable sentence rippled out from a German company. Wirecard, a star of the European tech scene, announced it could not find 1.9 billion euros. The money, supposedly held in trust accounts in the Philippines, had simply vanished. This was not a small accounting error. This was a quarter of the company's entire balance sheet, a sum so vast it seemed impossible to misplace. The initial reaction was one of pure disbelief. How could a company audited by one of the world's top firms lose track of a fortune large enough to fund a small nation? The news landed like a physical blow. Investors who had poured their savings into what they believed was Germany's answer to Silicon Valley watched in horror as the stock price began a freefall. Analysts, who had recently praised the company's aggressive growth, were left speechless. To understand the fall, one must go back to the beginning. Wirecard was born in 1999, not in a glittering financial capital. It started in Aschheim, a quiet, orderly suburb on the outskirts of Munich. Neat houses, tranquil atmosphere. It was the dot-com boom, wild optimism about the internet. Wirecard's mission: solve a fundamental problem: how to move money online securely. It positioned itself as a payment processor, a digital middleman helping online merchants accept payments worldwide. It carved out a niche in a risky but lucrative corner of the market. Established banks were hesitant. Wirecard was willing to take on clients others would not. Online gambling platforms, adult entertainment websites. These were high-volume, high-risk businesses that needed reliable payment processing. By servicing this underserved market, Wirecard found rapid growth, a strategy built on navigating the gray areas of digital commerce. At the heart of the Wirecard saga were two men, a pair of leaders whose personalities and ambitions shaped the company's destiny. The public face was Dr. Markus Braun, the chief executive officer. An Austrian with a doctorate in social and economic sciences, Braun was the polished visionary. He often appeared on stage at major tech conferences, dressed in a signature black turtleneck, echoing the style of Steve Jobs. He spoke with confidence and charm about the future of digital payments, promising a world without cash where Wirecard would be the dominant force. To investors and the media, he was the brilliant strategist, the man who had built a small startup into a global powerhouse. Working in the shadows, far from the public spotlight, was Jan Marsalek, the chief operating officer. Marsalek was the enigma, the man people inside and outside the company spoke of in hushed, almost mythical tones. He was known for his sharp intellect, his taste for luxury, and his network of mysterious, powerful contacts. While Braun sold the grand vision, Marsalek was the operator who made things happen. For much of the 2010s, Wirecard's ascent seemed unstoppable. The company's stock price was on a relentless upward climb, making early investors and its top executives incredibly wealthy. It became the darling of the German stock market, a rare tech success story in an economy dominated by old-world manufacturing and automotive giants. The narrative was intoxicating: a nimble, innovative fintech firm, outsmarting the slow, traditional banks. The company's growth was fueled by a series of acquisitions, buying up smaller payment companies across Asia, other emerging markets. On paper, this created a vast, global empire processing payments in dozens of countries. The praise was loud and came from the highest levels. Politicians, including German Chancellor Angela Merkel, lauded Wirecard as a national champion. Major investment banks, consulting firms published glowing reports. In 2018, Wirecard replaced Commerzbank in Germany's DAX 30. While most of the world was cheering, a small group of journalists at the Financial Times began to notice that the story was too good to be true. Starting as early as 2015, reporters, led by Dan McCrum, started publishing articles that raised serious questions about Wirecard's accounting practices. They found inconsistencies in the company's financial reports and pointed to an unusual and inexplicable gap between the cash flow it reported and the profits it claimed. These were not minor discrepancies. They were fundamental red flags that suggested something was deeply wrong with the company's books. The initial articles were met with fierce denials from Wirecard. The investigation intensified in 2019 when the FT published a series of explosive articles based on information from a whistleblower inside Wirecard's Singapore office. The reports alleged a conspiracy to fraudulently inflate sales and profits at various subsidiaries across Asia. They detailed specific instances of round-tripping, where money would be sent out of the company to an external party and then sent back, disguised as legitimate business revenue. The turning point came in the spring of 2020. The special audit by KPMG, which Wirecard had hoped would exonerate it, was a bombshell. The auditors announced they could not verify the existence of the euro 1.9 billion in cash that was supposedly held in trust accounts on behalf of Wirecard's Asian partners. The money was said to be in two banks in the Philippines, BDO Unibank Bank of the Philippine Islands. Suddenly, the abstract numbers in the financial reports became a concrete object of a frantic, real-world search. The company's primary auditor, Ernst & Young, refused to sign off on the 2019 accounts until they had proof the money was real. A desperate scramble began. Investigators and auditors descended on Manila, a city of humid streets and bustling commercial districts, a world away from the sterile corporate parks of Munich. They went to the banks, armed with documents provided by Wirecard that were meant to prove the existence of the massive accounts. But soon a clear and horrifying picture emerged. Officials at both BDO and BPI stated unequivocally that Wirecard was not their client. The accounts holding the euro 1.9 billion did not exist. They had never existed. The documents that Wirecard had presented as proof were exposed as forgeries. Bank letterheads, account statements, signatures of bank employees had all been faked. The governor of the Philippines Central Bank later confirmed that the money had never entered the country's financial system. The revelation was stunning. This wasn't a case of money being moved or lost. It was a case of money being invented. The euro 1.9 billion was a ghost, a phantom figure created to inflate Wirecard's balance sheet and deceive the world into believing the company was far more profitable and cash-rich than it was. Once the news from the Philippines became public, the collapse was swift and brutal. On June 18, 2020, the carefully constructed illusion shattered in an instant. The company's stock price had already been volatile, then it went into a terminal dive, losing more than 98% in days. Billions of euros in market capitalization evaporated. Investors who had held on, believing Markus Braun's promises, saw their life savings wiped out. The German tech champion became a penny stock overnight. Corporate leadership disintegrated. Markus Braun resigned. Days later, he turned himself in Munich and was arrested. He faced charges of false accounting. He faced charges of market manipulation. The man who once promised to revolutionize finance now faced a long prison sentence. The company's board was in chaos. Banks that had lent billions scrambled to recall loans. They realized the collateral was based on phantom assets. The wider financial ecosystem began to crumble. Within a week, Wirecard filed for insolvency. It was the first DAX member to do so. The company was bankrupt. While Markus Braun faced the German justice system, the other architect of Wirecard's rise and fall, Jan Marsalek, simply vanished. After being suspended from his role as COO, he told colleagues he was flying to the Philippines to find the missing money himself and prove his innocence. He booked a flight to Manila, and immigration records there were later produced to show his arrival. But it was all part of a final, elaborate deception. The flight records were faked, just like the bank statements. Marsalek had never gone to the Philippines. Instead, he had slipped away into the shadows. His escape became a mystery worthy of a spy novel. Investigations revealed that on June 19th, just after the fraud was exposed, Marsalek had taken a private jet from an airfield in Austria, flying to Minsk, the capital of Belarus. From there, the trail went cold. Rumors and intelligence reports began to swirl. It was claimed that Marsalek had deep ties to various intelligence agencies, including Russia's GRU. Stories emerged that he had been spirited away to Moscow, where he was living under the protection of the Russian state. He was no longer just a disgraced executive. He was an international fugitive with a history of dealing with spies and shadowy figures. The search for Marsalek has turned him into a modern-day ghost. His whereabouts remain one of the biggest unsolved mysteries of the financial world. Whispers place him everywhere and nowhere. One bizarre but persistent rumor suggested he was hiding out in a compound near Moscow, possibly even posing as an Orthodox priest. Another suggested he was using his intelligence contacts and vast, hidden wealth to live under a new identity in some undisclosed location. He had become a phantom, much like the billions his company claimed to possess. The man who operated in the shadows had disappeared into them completely. His disappearance adds another layer of intrigue and menace to the Wirecard story. Today, the once bustling Wirecard headquarters in Aschheim stands as a monument to the scandal. Imagine an empty boardroom on the top floor. The long, polished table is clear, the leather chairs are pushed in, the large video screens on the wall are dark. The air is still and cold. Through the floor-to-ceiling windows, one can see the orderly suburbs of Munich. A world that now seems impossibly distant from the global deception masterminded from within this room. This silent space is the final scene of the drama. A place where ambition and greed converge to create one of the biggest financial frauds in modern history. The fallout continues to spread. Investors lost their money. Employees lost their jobs. Germany's financial industry's reputation was severely damaged. The scandal forced a painful reckoning, leading to reforms in financial regulation, reforms in auditing practices. It showed how a culture of national pride can create blind spots, allowing red flags to be ignored. It demonstrated the power of a convincing narrative, especially when tied to a soaring stock price, a stark reminder of the fragility of trust in our complex, interconnected financial system. The case highlights the adversarial role of investigative journalism. Without the relentless work of the Financial Times, the fraud could have grown for years longer. The reporters faced down lawsuits, surveillance, immense corporate and political pressure. Their work is a testament to scrutiny and asking hard questions, especially when everyone else is caught up in collective euphoria. It proves a free and aggressive press is a vital check on corporate power. We return to the empty boardroom, echoes of collapsed fortunes and shattered reputations. The story of Wirecard is a warning. In a world of digital transactions and complex global finance, things are not always what they seem. Even the most respected auditors, regulators, and investors can be fooled. The scandal leaves us with an unsettling question hanging in the cold air of the room. Who's watching the watchers? Subscribe to InvestBuddy AI for more financial true crime. Comment below. Where do you think Jean Marsalek is hiding?